this is Ira Koyner, the original IRA from Triathlon Partners. I want to ask you, has the recent market drop made you think how you're investing? Maybe you're wondering, what should I invest in now to reduce the volatility of my portfolio? Now, a lot of people default turn to US bonds, but honestly, I think that's a mistake. Why? Because bonds can lead to years of underperformance. Instead of asking what to invest in, the better question is, how should I invest? When the market drops 20% in 2 months, it's scary, especially if you're retired or close to it. A significant loss like that might mean working more years or lead to a lifestyle downgrade during retirement. But your goal is simple. Don't lose big when the market drops and still grow your money when the market rises. That might sound like wishful thinking, but at Triathlon Partners, we integrate products that do just this into your portfolio. That's how we invest. Let's start with structured notes, specifically growth notes. They offer protection when the market drops and extra upside when it appreciates. Structured notes offer a variety of protection options. They have fixed protection, for example, 20%. So the first 20% loss in the security is covered. So if the underlying investment is down 30% at maturity, you only lose 10%. There are also notes that offer 100% protection, guaranteeing 100% of the investment if the market drops. There's also conditional protection. The market is down less than 30% at maturity, you get all your money back. If it's down more than 30%, your return is the same as the underlying investment. On the upside, they offer enhanced returns. If the market goes up 20% and the note has a 1.5 multiplier, you earn 30%. To summarize, structured notes have less downside and more upside, a great combination. Another product is registered index-linked annuities. They also offer permanent protection that ranges between 10 to 30%. For example, if you have 10% protection called a buffer, and if the market drops 15%, you're only down 5%. The upside is capped, but current cap rates range from 15 to 25%, depending upon the underlying investment and the market dynamics. They track real indexes like the S&P 500 and NASDAQ, and they reset each year, giving you a new buffer and cap. All growth and gains are tax deferred, and taxes are paid when the money is withdrawn. Another great example of an investment with protection is indexed universal life insurance, or IUL. Now, it's just not life insurance. It also offers protection on your investment, and it's tax advantaged. The investment has a 0% floor, which means it doesn't lose any money in down years. The caps range from 10 to 13% currently. All withdrawals from the investment can be tax-free, and there are no income limits or contribution caps like there are with Roth IRAs. And this is a very estate-friendly investment. Think of it as a Roth IRA with more flexibility, no limitations, and no income restrictions. Well, if this hasn't convinced you and you still like bonds, bonds usually yield 4 to 5% a year, but they don't protect against losses. A better option is called a MYGA, a multi-year guaranteed annuity. They're just like CDs, but instead of issued by a bank, they're issued by insurance companies. They have a higher yield than U.S. government bonds, and they offer tax-deferred growth with no taxes due until the money is withdrawn from the annuity. Now, if you're comfortable with CDs, MYGAs offer a better interest rate and more tax efficiency. Now, I want you to ask yourself, do bonds protect your money when markets drop? Do they offer extra growth and participation when the markets rise? And do they provide tax deferral? The answer to all three of these is no, they do not. That's why Triathlon Partners recommends structured notes, RILAs, IULs, and MYGAs. They provide protection upside potential and long-term tax efficiency. That's how we invest. Now, thanks for tuning in. This is Ira Koyner, the original IRA from Triathlon Partners. Have a blessed day.